Hey guys, welcome again to the Pragmatic Investor. And before you say anything, I know that I really need to shave. It's been long overdue, but my machine broke and I'm going to the barber soon. So anyway, to the important news of the day. Of course, today we got that CPI release data coming in as we expected, below expectations. So let's focus on the core CPI because that is the, let's say, most significant data point. Now, core CPI went down to 4.8% on an annualized basis. And then, of course, on a month-to-month basis, we had a 0.2% increase, actually higher than the previous month. Yet, markets and stocks are rallying today on the back of this disinflationary data. Now, of course, the disinflationary trend has been happening for the last few months. It's been kind of the consensus view. Of course, a lot of the inflationary pressures that happened through COVID, which were tighter supplies, and to an extent that boost in demand due to the COVID relief, are now kind of taking a step back. On top of that, we are seeing the effects of tighter monetary policy. Of course, a number of rate hikes that are making their way through the economy and still will make their way through the economy in further weeks and months. And of course, for example, we're seeing much lower prices in commodities. Now, we also have what we might call leading indicators showing that disinflation is bound to continue. And this is something that we actually saw on Monday with the Chinese release of its PPI data. Now, the PPI has historically acted as quite a good forecast of where US headline CPI is, and we saw both in China in terms of CPI and PPI surprising us to the downside. So the question is this disinflation transitory or permanent? Kind of the same question we had to deal with when it came to inflation. And now, although I do see more disinflation coming and of course eventually deflation, as I see the possibility that the Fed is already over tightening. In fact, even in the face of this news, the expectation is still that the Fed is going to raise hikes in the next meeting. What I would like to do in this video is consider the inflationary scenario, right? So what are the odds that we actually get more resilient inflation than we expect? And this argument can't be dismissed, even though it now seems very clear that disinflation is the path forward. You know, it also seemed very clear at one point that inflation was the path forward, and we saw how investors were so wrong-footed. So let's consider the inflationary scenario, okay? Now, number one, wages, okay? Wages are a very important component of inflation. Now, of course, we've seen wages go up with inflation, and in fact, what we've actually seen now is that as inflation has begun to cool off, wages have actually remained at decent levels and started kind of lagged behind inflation. In fact, this has created a wealth effect whereby wages have been a bit higher than the inflationary pressure. Now, the question is, are these wages going to come down with inflation? If they do, of course, we would expect that disinflation to continue. And if they don't, then inflation might be a lot stickier. And we have some reasons to believe that they might actually be a bit stickier, right? For one thing, we have a structurally tight labor market. Okay, so we have a big part of the population, the boomer generation, entering retirement age, and the active population becoming a much smaller proportion of the actual population. Okay, so structurally low unemployment might be here to stay, and that might prevent wages from really coming down and getting that kind of inflation back to that 2% target. Interestingly, this is something that we've already seen happen in the UK, which has suffered from a wage inflation spiral. Okay, inflation was kind of out of control, and it still is kind of getting out of control due to the fact that wages aren't coming down as you would expect. Wages have continued to increase even in the face of decreasing inflation expectations. Now, the other part of the inflation argument, at least in my view, comes from the side of the weakening dollar and how this will also affect commodities. Now, the weakening dollar narrative has been one that has been already talked about extensively. Stanley Druckenmiller came out at the beginning of the year talking about how he was shorting the dollar. And what we have now is a dollar that has actually held up quite well, but is beginning to break down, as we can see in this chart. And I also believe that this could be quite conducive to higher prices in commodities, which are actually at a very bearish point right now. Okay, sentiment in commodities is at the lowest it's been since about 2020. And from a technical perspective, I think we could really see a breakout. So with that said, in the face of higher commodity prices, a lower dollar, and resilient wages, how fast are we going to exactly enter this disinflation? And let's remember that typically it takes an actual recession to bring down the inflation levels to what you might call acceptable inflation levels. And that is something that we're not seeing yet. Of course, a recession is going to become more likely as we enter 2024 and 2025. A recession, of course, is always coming, and we're starting to see some signs that this could happen with, for example, the idea that consumers will be running out of money sometime around the end of 2023, 2024. And of course, that we're going to start to feel those lagged effects of monetary tightening. We're going to see mortgage rates really start to catch up with the Fed funds rate. And we're also going to see basically companies having to refinance at much higher rates. So that will definitely take a toll. At that point, definitely we'll enter disinflation and deflation. However, before that, could we get an inflation surprise?